What's going on, investors, and welcome back to the channel. And as promised, today's video is going to be covering Asos's latest earnings. Now, you may remember that I've been on record saying that I believed at the time of the video that I thought that Asos was a GARP stock, so that is growth at a reasonable price, after falling maybe 50% from its all-time highs, even more than that. Now, the stock has fallen a further 30%, so now the question becomes, do I still believe that, and what has caused that drop? So right up front, and we'll go through the earnings, but effectively right up front, I still believe that it's a GARP stock. I still think that you're going to get decent growth at a very, an even more reasonable price at this point, but there definitely are some headwinds for the business. And there are some difficulties that the business is facing. So we'll get into all of that, but up front, my opinion hasn't really changed. I still think that this is a fantastic business, and now you're getting it at an even cheaper valuation. So that is all very well and good, but there are definitely some downsides to be aware of. So we'll get into all of that. Now, when we flick across to Google Charts, we can see that the stock is down 73% in the last year, which is quite astonishing given the fact that this is a profitable company. We've sort of grown used to seeing companies that are not profitable but are in the hyper growth stage having fallen 70, 80, sometimes even 90%, right? But to see a company that is profitable and has been for years and years and years to fall 73% in a single year is quite astonishing. So that brings us down to a market capitalization of £1.5 billion. Interestingly though, had you have looked at this just a week ago, the PE ratio would have told you it's something like 10. And the reason for that is because after their latest earnings, they've seen a massive decline in profitability. So we'll definitely be jumping into that. So here's the first page of the earnings, and I want to try and make this video relatively structured because I can have a habit of digressing. So there are going to be four things that I want to focus on. That's going to be revenue, gross margins, operating margins, and then effectively anything else that I feel is necessary to talk about. And that is probably where we are going to digress. But anyway, revenues, gross margins, and operating margins are certainly going to be a focus of this video. So starting with revenue growth, and we can see that the headline number one point right here is that they delivered 4% revenue growth, and that's on a constant currency basis. When you actually take into account those currency fluctuations, revenue was actually only up by 1%. So as you can see from this chart here, we're used to seeing this company compound at much higher growth rates. Now, this is a chart of revenues over the last 15 years, and really that growth rate has been somewhere between 20 and 30% on average each and every year. And certainly over the last 5 years, we've seen somewhere between 20 and 25% in growth. Now, an interesting point to note here is that over the last 15 years, there has only been one time where revenues did not grow and actually they contracted. And that was in 2012 when we were in a recession. And the reason why I mention that is because given the current macroeconomic environment, where a lot of people are concerned that there could be a recession going forward due to the high inflation environment that we're in, which is resulting in higher interest rates. So clearly a recession is not going to be a good thing for a consumer discretionary business. I mean, it's in the name, right? So we've got consumer discretionary. People don't have to buy new clothes, and as a result of that, if there's going to be anything that they cut back on, potentially this would be one of them. Now, it is worth noting that management did actually guide for mid-single digit revenue growth, and as a result of that, on a constant currency basis anyway, they are right in line, but clearly it's still a little bit disappointing. And management cite two reasons for that really, which is the macroeconomic environment, which we've just discussed, and they expect that to continue to be a potential issue going forward, and we'll get onto that shortly. And then also slower customer growth, a result of cycling a period of exceptional customer acquisition in the prior year when high street retail was closed. Now, whilst that does make a lot of sense, effectively they're saying they've got tough comparables. The sort of issue I take with that is the fact that actually when we look at their revenue growth, in 2021 it was 20%, and in 2020 it was also 20%. Granted, they didn't have a great year in 2019 at 13%, but all of the years prior to that as well, it was pretty much higher than 20%. So effectively, their revenue growth in 2020 and 2021 was right in line with what I would expect. And so to then say that the reason that you're not beating that this year is because you had tough comparables, well, that doesn't really wash. And actually, I think that it probably comes back primarily to point one, which is the current environment that we're in, where people are facing, inflation north of 10%. And I know that's not the official figures, but that's what a lot of people are feeling. And as a result of that, discretionary spend is reduced. The good thing about that, though, is that that is generally a relatively short-term thing. and certainly ASOS have a fantastic business to weather that storm. However, it is definitely a symptom of ASOS and the type of business that ASOS operates in not having incredible pricing power. And we can see that lack of pricing power in the fact that their gross margins have fallen from 45% last year by 190 basis points to 43%, which of course isn't great. And when we look to the financials, we can see that over the last few years, in fact, their gross margins have been declining, once again illustrating the point that this type of business, and ASOS in particular, where they tend to be the sort of cheapest option for many different types of clothes, it doesn't offer fantastic pricing power. If they do try to raise their prices in line with the increased costs that they're facing, well, then they're going to lose customers. So we can see these gross margins here, where from 2018 we were sitting at 51%, and in 2021 we were sitting at 45%, and of course we've just seen there that we're back now down to 43.1%. So clearly we're seeing a steady decline in gross margins, and this for me is probably the most important factor to look out for. I still think at levels of 43% in the short term, so over this year and potentially next year, the business should be fine. But if it continues to remain suppressed at 43%, then that's definitely going to be an issue, because their operating margins are going to be severely impacted as well. Now, in terms of the reasons for those reduced gross margins, we can see a bridge here which effectively shows us how we get from the 45% gross margins to the 43% gross margins. And we see that the largest impact is clearance activity. So this is where they are having to mark down products because, for example, they didn't sell all of their summer clothing line, and as a result of that they had to discount these items to get rid of them, because they don't want to be holding them for an entire year, because of course that comes with additional warehouse costs. So what they will do is they will discount these products to try and get rid of them, and as a result of that they are impacting their gross margins. There's also an element of freight and duty costs, or increased freight and duty costs, which are impacting their gross margins. And of course we all know about that, right? The fact that freight and duty costs have increased by a significant amount, and therefore this is nothing new, and certainly this is something that every business within the industry will be facing. So that one is less of a concern than the clearance activity, because the clearance activity demonstrates a lack of demand, whereas freight and duty is external pressures that they can't really do anything about. And just focusing for a moment on these freight and duty costs, when we go across to the transcript, we can see here that management said that they have locked in sea freight contractually for the balance of the year, which is obviously very good, right? Because if freight costs continue to increase, ASOS are not going to be hurt by that increased cost. A positive here though is that they were able to offset some of those increased costs with better buying margin. So they have negotiated with their suppliers, and effectively they've been able to get better pricing on their products. And management are saying that for the second half of the year they expect gross margin trends to improve, but they expect gross margins to be between 100 and 150 basis points down for the year. So we're looking at somewhere between 43.5% to 44% gross margins for the full year, rather than the 45% that we saw last year. So clearly that's an issue, but we are starting to see that trend reverse. So potentially, it's definitely something that we want to keep an eye on. So then that brings us on to operating margins, because we can see here that operating margins last year were 5.6%, and that is down 580 basis points to a negative 0.2%. And that's because they posted a £4.4 million loss compared with a £109.7 million profit the year prior. So we're definitely going to want to dig into what is driving those increased costs that the business is facing that are resulting in a loss for the year. And we can see that those increased costs are right across the board. So we're looking at distribution costs, which are up 30 basis points, warehousing costs, which are up 160 basis points, marketing costs are up 50 basis points, depreciation is also up 30 basis points. And actually, effectively they're being absolutely impacted right across the board, and that's probably not that surprising given the rates of inflation that we are all experiencing. So if we think about each of these in turn, well, freight costs, management have already mentioned how they are mitigating against further increases in that area, so that's definitely a good thing. However, for fabric prices and wage increases, these are just sort of typical inflationary pressures that the industry and the wider economy is facing. As a result of that, I don't suspect that these are going to come down, and as a result of that, management are going to have to continue to improve on these cost efficiencies if we are to get anywhere back to the sort of operating margins or EBIT margins that we were used to seeing for this business. Now, the easiest way, of course, for management to mitigate against those cost increases that they are facing is to pass those on to the consumer and therefore raise prices. And that is what they have been doing, but they've been doing that by a very low amount. So low to mid-single digit price increases took effect from January. As a result of that, we're only seeing 2 months worth of those results, but we can see that that hasn't had a significant impact on gross margins so far. So given the fact that this was only 2 months, I'd be interested to see how these price increases impact both their gross margins and their operating margins going forward. And once again, that's something that I'll be looking out for in their next earnings report. Now, you may be aware that ASOS withdrew their operations from Russia due to the invasion of Ukraine, and that accounts for around 2% generally of group revenues, but it does also account for around £20 million on a normal year of profit before tax. And that is a significant amount of money. It's certainly a high proportion of profits than it is revenues. So that is definitely something that is I guess, a necessary step for the business to take, but it is going to be a hit to shareholders. So management are saying that, save for the removal of Russia's contribution to H2, following the decision to suspend sales announced on 2nd of March, guidance remains unchanged. So the fact that guidance remains unchanged, excluding the Russia operations, is obviously very good. So they have had a difficult half of the year, but guidance for the full year remains the same, which is good. Now, they do say that there is a greater risk in H2 than normal, as the full impact of recent inflationary pressure on consumers and the potential impact on discretionary spend are yet to be felt. And that's, of course, what I was mentioning earlier on. This is a consumer discretionary business, and when people are, facing tough financial times, which unfortunately I think a lot of people are, then clearly the spend for ASOS is going to be reduced. And certainly management are concerned, and they said this in their transcript as well. They are concerned what impact that will have on the business. And actually, one of the things that management said is that this is one of the most difficult periods that the business has potentially faced, and they're just not sure what that's going to look like from a financial perspective. So there is a massive amount of uncertainty here, and it's all of these factors which have been building up over time, which has resulted in that, that 70% decline in share price. But it's not all bad. So despite the external challenges, ASOS anticipates sales growth to accelerate in H2, supported by an improved stock profile, which is definitely very good, easing of comparative growth rates, which is, neither here nor there, return of event and holiday-led demand though, which is certainly very good. We've said this a few times before, but hopefully we are now in a period of time where we're not expecting any future sort of COVID lockdowns, and as a result of that, that's going to help a business like ASOS with increased events and holidays. Increased marketing investment to support international sales acceleration, that is definitely very good. And then improved lead times as supply chain constraints ease, which is very good as well. So all of that is to say this, which is that ASOS looks to the future with confidence and remains committed to the execution of its medium-term strategy in support of long-term growth acceleration. So clearly that's very good, because their medium-term strategy is £7 billion in revenue by 2025 and something like 4% profit margins. So if they can achieve that, there would be significant upside you would expect for this business. Of course, given the fact that this is management that are saying that, you have to take it with a pinch of salt, and you have to scrutinise the possibility of them achieving that £7 billion in revenue by 2025, given the current times that we're in. But certainly management remain confident of that, and they're not adjusting that guidance, which at least is something. Now, looking at this from a balance sheet perspective, things are looking decent at this point. So they've got current assets of £1.5 million, current liabilities of just under £1 million. As a result of that, they've got a current ratio of about 1.5. Now, they've got cash and cash equivalents of £406 million, which is up from £92 million the year earlier. So you might be wondering, well, where has all that cash come from, if we've just realised that, well, effectively, at least over the last 6 months, the business was loss-making. Well, we can actually see that if we go down to borrowings, long-term borrowings, they've now got £468 million of debt on the balance sheet, whereas a year earlier they did not. So, that although that position is unchanged from 6 months ago, it's still important to note that, when you're comparing year over year, borrowings have increased significantly. That was in line with our expectation, because we knew that as of sort of last year end, but it's definitely something that, we need to be aware of. So John here has asked a couple of questions, so I'll quickly run through these. Has there been any significant change in the company direction with the new CEO? The short answer to that is no. It looks like the company are very much committed to that medium-term goal, and that remains unchanged. I don't think the new CEO is made any significant impact at this point in terms of changing the direction of the company, which is good, because I like like the direction that the company is heading in, although of course in the near term things aren't looking great, but that is just a symptom of the wider economy. Now, has there been any new share dilution or increase in debt loads? So I've just mentioned debt, where from the year end there hasn't been a material increase in debt, but from a year ago today there was. So that's definitely something to be aware of. Any increase in share dilution? No, there hasn't. So we can see here the weighted average shares in issue for diluted earnings per share is 99,675,000 compared with 99,878,000. So no, there hasn't been any share dilution, which is obviously good. I don't expect there to be any share dilution for the time being, given the fact that they've got £400 million worth of cash on the balance sheet, and I'm expecting them to be sort of free cash flow positive again, maybe a year from now. So shouldn't be an issue, but definitely something to keep an eye on anyway. Another question is, how are the expansion plans in the US going? They're actually going pretty good. So the US is their smallest market at the moment. They've got 3.5 million customers, or active customers, but their total sales are up 11% year over year. Now, you look at the sort of growth that we're seeing in the other regions, it was just 1% for the EU, and it was 8% for UK. So US is going strong, but they do have a long way to go to reach the levels of the UK and the EU. So active customers of 3.5 million compared with 10.5 million for the EU and 8.8 million for the UK. So the expansion into the US is going well. Things are looking pretty good there, but I think we're a long way to go in terms of catching up with the other regions. And then, is the 1 to 2 day delivery policy a moat for them? No, I don't think it is. I think that if you would have asked that question 3 or 4 years ago, it probably would have been. But I think that the vast majority of retailers now are offering that kind of service. As a result of that, if everybody's offering it, then of course it can't be a moat. But I suppose just to expand on that, in my opinion, their moat, if you can say that they have one, I don't think they have a significant moat. But if they do have a moat, it's the fact that they are typically the best priced for the majority of products. It's their range of products that they offer. So they have a wider offering than pretty much any other website, as far as I can tell. And it's the fact that they sell not only their own products, but they also sell the products of others as well. So if you want some Adidas trainers, for example, you can go onto Asos's website. But if you want some Asos branded clothing, you can also go to Asos's website, and I think that is a big benefit for them. So I wanted to very quickly skim over my valuation model for the business. Now, I've already run through this in some detail in a previous video, so I'll try and be relatively quick here. But effectively, 1 to 5 year revenue growth, I'm expecting 10%. Now, that comes in the form of 5% in the first year and then 12% thereafter for years through to 2026. I'm then expecting that revenue growth to decline to 8% thereafter. Now, an important thing to note here is that management has said that their medium-term goal is for £7 billion in revenue by 2025. I'm saying that they're not going to hit £7 billion in revenue until 2027. So I'm not giving management the full credit for that target that they're aiming for. And then in terms of gross margin, so we can see that decline in gross margins over time. I'm expecting that to continue to decline into 2022, where we're looking at 44% in line with management's guidance, where then I'm expecting that gross margins then start to tick up again as they pass on those increased effectively costs to the consumer, where we see them plateau at 47% by 2025. It's important to note here that a gross margin of 40% is still below their historical average of 49%, so I'm not asking for a significant uptick in those gross margins. One thing that I've not spoken about in this video, which I did speak about in the previous video, was the automation of their warehouses, and that they're investing a significant amount on CapEx in order to do that, and I expect that to drive increased margins over time. As a result of that, I'm looking at operating margins of 3% in 2022, increasing to 6% by 2025, and then once again net profit margins to be from 2.1% in 2022. So that's just £86 million in net profit, down from £128 million in 2021, and for that to increase over time to 4.4%, which granted is slightly higher than what they've seen in previous years. So even in their good years, they were looking at 3.5%, round about there. But as I said, I think that the various investments that they are making, such as the automation of their warehouses, will help to drive those net profit margins. And a net profit margin of 4.4% isn't anything ridiculous for this type of business. That means that by 2031, we're looking at revenues of £9.5 billion, generating net profit of £417 million, up from £128 million of net profit in 2021, and just under £4 billion in revenue in 2021 as well. Now, in terms of the weighted average cost of capital, we're looking at 13.2%. So that is a fairly high discount rate. And the reason for that is because this is a very volatile stock with a high beta. Now, a lot of people take issue with using weighted average cost of capital. I'm not going to get into the details of that in this video. But anyway, we're looking at effectively no free cash flow to be generated in 2022, but for that to then significantly increase thereafter to be more or less in line with the net profit figures that we are looking at earlier on. So within my valuations, I always try to be as conservative as possible, and that way I try and protect myself from further downside risk. We're looking at an intrinsic value of £24 a share from the discounted cash flow, around £20 a share from the multiple of earnings, which is based on a P ratio of just 15. Now, if we were to look at the historical P ratio, you would see that it has never been as low as 15 until effectively the last year. So I think that 15 is definitely reasonable. And if we take the average of the two, we get a fair value per share of £22. Now, again, I actually personally think that the fair value of the business is much higher than this. But what I've tried to do is I've tried to be super conservative, super low revenue growth rates, super low margins, certainly in the earlier years, where that then ticks up in subsequent years, to try and ensure that I'm protecting myself against significant downside risk. Of course, this is just hypothetical, and things could go way higher or way lower. But as a general outline, a margin of safety of 50% with a discount rate, by the way, of 13% means that over the long term, I think that things are looking pretty good for this business. But of course, that is just my opinion on the direction of this business over the next 3 to 4 or even 5 years. Of course, I could be wrong, and I have been wrong before, so we will see. Anyway, guys, I hope you enjoyed the video, and until next time, thank you.